Welcome to episode 1 of Road to $1 Million Stock Portfolio podcast. My name is Supergirl Investor, here to save the world and make you wealthy, and we have a jam-packed podcast for you. Today, I wanted to discuss everything about investing for beginners, what type of brokerage account I'm going to use, because we are going to go over a completely new stock portfolio. I am so excited. Going to try to get $1 million in high quality, safe companies that are undervalued. I'm going to tell you exactly what I'm doing on my journey, how I'm making money, how I'm doing everything possible to make this a $1 million portfolio in hopefully 10 years. And I know that is very quick, but I've been getting so much demand and a lot of people asking me how to get started, asking me all of these questions. So this is basically a very fun party where we are going to try to get to $1 million. And this is going to be an invest with me. If you would like to join me along with this journey, I have a free dividend tracker that is in the link in the description below. So let's get started. And as always, just let me know if you have any questions below. In the first episode of this podcast, I wanted to get you set up for success. I've made a lot of mistakes as a finance and accounting student in NYU. I've been investing for a little over 10 years, and there's lots of things that I wish I had known 10 years ago. So I'm going to give you all of my secrets and try to share as much value as I can in this episode. So we are going to go over my personal favorite investing brokerage account for beginners and why I think it's my favorite, how exactly to open an investing account. This is jam-packed and it's going to be a lot of hidden gems. At the end of it, I'm going to give you my favorite 5 dividend stocks to invest for the long term. These are high quality dividend stocks that are safe for investing beginners. Before we get started, this podcast is sponsored by BarChart. BarChart is my free stock screener that I use to find all of my stocks. It gives you all of the information, all of the news, gives you politician insider trading, and many more features. So whether you're a long-term investor or a day trader, this is for you. Use the free link in my description. After the whole fiasco with FTX, it's more important than ever to come up with a brokerage account that is good for beginning investors and very safe. We want to make sure that it is ensured that it's high quality and that it's a brokerage account that we can rely on in the event of a liquidation or bankruptcy. We want to make sure that this company will give us our money back in case anything happens to the actual company. A few mistakes that I've been noticing when choosing a brokerage account are the following. Number 1, hidden fees. And we will talk about the number 1 brokerage that does this, and I really do not like this platform. Number 2, if it's not backed by any type of insurance, do not go into this account. Number 3, we want our brokerage account to weather the storm, to be fee-free, to be backed by insurance, and to be reputable. There have been so many investing brokerage accounts that have just popped up, and we know that every single FinTwit or YouTube influencer has been touting a lot of these platforms, but are they really that great? Is it really great if we're getting crypto for $50 for free in one investing platform that we can't get out of it for a year because there's contingencies on it? These types of mistakes follow you down a rabbit hole and you can lose thousands of dollars. So the number 1 platform to avoid, we want to avoid E-Trade. Now I know E-Trade is very popular. I do have an E-Trade account. I am trying to liquidate that and transfer that as we speak, but I do have a few options on it right now. So I'm just waiting until those options expire and then transferring it to another one because the hidden fees are outrageous. And I've had E-Trade for a very long time, but I'm going to bring it over to my number 1 brokerage account very soon. Now, when I say hidden fees, I mean that they are charging $39 per stock split. That's right. That means if Google, Microsoft, Apple, if any of them have a stock split, you're going to pay $39. Another thing that I really don't like about them is that it's going to cost you around $49 just to purchase an outside mutual fund. And last, if you're opening a retirement account with them, they're going to add those dividends that you receive on any of your stocks or indices, and they are going to make sure that it is a short-term capital gain. And short-term capital gains for retirement funds are again $49 in fees. So for me personally, the hidden fees in E-Trade is just a little bit bonkers, especially in this period of commission-free trading, and basically many brokerages making less hidden fees or no hidden fees at all and making it very consumer-centered. Second, if you have anything like SoFi or M1 Finance, make sure your crypto is backed by something. Now, I'm not talking about investment securities. I'm talking about crypto for this one. It is not insured. So therefore, crypto is very risky in these platforms specifically. I'm talking Webull, I'm talking SoFi, I'm talking M1 Finance. Instead, what you will want to do is create your own wallet and then buy Bitcoin or Ethereum or whatever crypto coin you want within that wallet. It's the idea between a bank, but it's not backed by anything, versus your own purse or your own wallet. Last, we want to make sure that the brokerage account is reputable. It has a very good reputation. You know exactly which brokerage account I'm talking about, and that it is based in a country that has a lot of regulations for the consumer. This means that it's US based or it's Canada based or in Europe. So we just want to make sure that the reputation is there and that it's in a highly regulated country that's consumer centric. So we're basically looking at Vanguard, Schwab, Fidelity, and my personal favorite, M1 Finance. The best investing brokerage account for beginners, in my opinion, and what I have found is the most visually appealing, most user-friendly for beginners is M1 Finance. It has a great reputation, even though it's been a new kid on the block. I've spoken with many customer representatives, and they have been very quick to help me. It is insured, and it has no hidden fees. I personally love using this because I am a very visual person, and I also like things done quickly. And this is a very automated way for me to lead my busy life studying for all of my midterms in finance and accounting, and to just see my investing portfolio. Why this is one of the best brokerage account for beginners is because M1 Finance is commission free. It's very easy to use. You can automate it, and you can build very healthy financial habits with this platform. What I mean by this is that it's very easy to use if you are a long-term investor. There are several trackers where you can track all of your progress, and especially if you're a dividend investor, it helps to see the compounding snowball effect that we will talk about later in this episode. You can choose any different type of brokerage account, individual, SEP. Your portfolio comes in slices, which makes it very visually appealing. It makes it very difficult to use if you're trying to trade. You can easily manage your stocks, ETFs, or indices, and you can see how your stock portfolio is doing against the benchmark S&P 500. There's also a one-day trading window, so you can only buy or sell certain stocks or ETFs in a one-day period. And I personally feel as a beginning investor that this is great for that long-term investing mindset because it has all of the tools in place to become a long-term investor and to build those daily healthy habits. So let's do a little bit of invest with me and let's open our own M1 Finance account. It's like the start of a marathon. M1 Finance is super simple and easy to use, so you can use it on your computer or you can use it on your iPhone. Very convenient. They have checking, they have savings. They are going to implement in January of 2023, which I'm so excited about, a 4.5% APY savings account. Yes, you heard that right, 4.5%. Here's how to open an M1 Finance account. We're going to sign up for M1 Finance. We're going to go into the app, add account. We can choose individual investing, crypto account, joint investing, retirement, trust account, custodial account for the little ones. I'm just going to choose individual. Note that this does have to do with taxes, and in one of the sections in this podcast, we will talk about what to watch for as a beginning investor, what you need to look out for, and one of those is taxes, especially with certain type of stocks and certain types of accounts. So we're going to click individual investing. Please, please, please read through the policies, read through all of them, talk to your accountant, because again, you don't want to make the mistake that it's not insured and there are no fees. make sure that you do your due diligence the same way you would do due diligence for investing in stocks. Click confirm. You will see that you have to verify your email address, build a portfolio, and make a deposit. You will also notice at the bottom that it says buying power is $0. And there's also auto invest, which is another great feature of M1, which I personally love. And it tells you when the next trade window is. This is when you can buy and sell stocks. It says tomorrow morning at 9:30 a.m. Buying power is just the cash that you deposit into the account. And if you turn auto invest on, this means that whatever portfolio that you create, your pizza pie, let's say, the slices that it will allocate into the percentages that you want. So once you've verified your email, we will go to Manage Pie, Edit Pie. We will go to Add Slice. We will go to Funds. I'm going to go to VTI, which is the Vanguard Total Stock Market ETF. We will talk about that later. Click Add to Pie. Look at that juicy dividend yield of 1.55%. Of course, I'm being facetious, but they have a very huge market cap, one of the largest market caps in the world, making this one of the largest companies in the world at $271 billion. Now, you can put this on your watch list. You don't have to add it to your pie, but basically we're going to create a pie or a stock portfolio, and each slice of this pizza pie or pumpkin pie, because I really love sweets, you're going to create. Now, I would suggest to have between 10 to 20 individual stocks. The more diversified you are, the less risk, but there is a threshold for that. But as a beginning investor, we want to focus solely on ETFs. And again, we will go over that later, but basically ETFs are exchange traded funds, and this Vanguard Total Stock Market ETF basically holds the entire stock market. So tons of companies, very low risk. So we're going to add to pie and then click done. And we're going to set the percentage to 100% just for now. Click save, confirm. And then last we will need to deposit. So click deposit, choose your checking account, choose the brokerage account that we just did. And we will need to do a minimum of $500 when first starting out with this account. I do not have $500 right now just lying around because I put most of it into my investing platforms, or I pay most of it off. But then basically it will be pending until the next trading window. Now, the number one mistake that most people make that I've been getting so many questions about in the brokerage account is that they leave the money in the brokerage account and leave it within this thing that says buying power. This doesn't mean that you're actually investing. This means that you are just adding cash to your what's known as dry powder. If you handed your banker some cash and then just left it, and the banker's not doing anything with it, they're just like putting it in the drawer. So what you need to do is invest that money. So once it's in the brokerage account, you need to invest it. It is not invested if you solely put it in that brokerage account. So let's say I have $500 into my investing brokerage, and we are going to have auto invest. Make sure that it is blue. It needs to exceed $25 of your minimum cash balance. Your minimum cash balance will remain uninvested in your account. So we're going to set the auto invest minimum to $25, and it means that trading will be initiated once you have at least $25. You can set a minimum cash balance to remain uninvested in your account, and trading will be initiated once your balance is at least $25 over that set amount. So it has to be $50 because we just made it $25. All deposits and dividends are added to your cash balance. So any dividends that come through are going to be put into your cash balance. They're not going to be reinvested into another stock. And also, if you're going to withdraw, it will be taken from your cash balance first. So we're going to have auto invest on because once I deposit something into this account, I want it to go to the allocated VTI Vanguard Total Stock Market ETF after the initial $50 that we just placed. And again, it goes to whatever stock or ETF that you put into this portfolio and the percentage is allocated. So let's say we put $100 into this brokerage account. If I have VTI at 10% of my pie, $10 will go into VTI, and $10 will go into VTI during the next trade window, which is 9:30 a.m. Bonus points if you name your portfolio, and this should be something that inspires you. I might name this Cabo Retirement, or let's say you want to buy a house. Maybe name this portfolio My Dream Mansion, because if you visualize and write down your goals, it will make you 40%. Yes, 40% more likely to achieve that goal. Now, I know that's an outstanding number, but this was based on a Harvard study, and I've personally realized that it is a lot easier to reach my goals when I write them down and visualize them. So for this portfolio, I want to save the world and make you wealthy. So it's going to have something to do with Supergirl Investor. So we're going to name this Wonder Woman Millionaire and then hit save. Confirm. Now that we've done a little invest with me with a new brokerage account for beginners and why I like M1 Finance, let's decide what type of account should you choose. The main criteria in personal investing is that it is personal. So which type of account should you choose? The one that is focused on you and your long-term goals. What is your end goal for your finances? Do you want to have $10 million in a stock portfolio? Do you want to have a whole bunch of real estate? Do you want to retire early? What are your actual goals? Write them down and map out how long that's going to take you. Because knowing your end goal will give you the answers that you need of what type of account you should choose and what stocks or ETFs you should pick. How much money you're making factors in. What your life is like, how many children you have, if you have a family, if you like luxury, which is completely okay. It is okay to have that Starbucks. But you just need to know the type of person you are. Sit down, be incredibly realistic with yourself, and see how you can cut down on some expenses or make more money to get to the goal in the time frame that you set. Also be aware that your cash, if it is just sitting in a checking account or a savings account, because inflation is so high and it's around 8%, your money, your actual cash is losing 8%, whatever the inflation rate is, 8% this year alone. And S&P 500, as it's like to be called, actually makes an average of 8% compound annual growth rate. So this means that your money is basically balancing out this year, which I know doesn't sound great, but we're here to preserve your wealth. We're here for you to make generational wealth, for you and your family to be stable, to get out of that rat race, to retire early, whatever is in your long-term goal. 3 key factors when deciding which type of account to use. Number 1, what is your time horizon? How long do you think it will take to achieve these goals? Number 2, is this for you or is this for you and a partner or is this for your children? Number 3, what type of employment do you have and what are the tax advantages? So number 1, your time horizon. If you are looking for this account to help buy your first house or looking for a short-term big investment that you are trying to possibly go to college with, or you're trying to get your own rental, you may want to choose the standard brokerage account. It's called individual investing in the M1 account, and it's sometimes called a taxable brokerage account or a non-retirement account because there are tax implications to it, because this is more liquid, or basically it means that you can buy and sell stocks and withdraw funds at your leisure. It provides access to a broad range of investments, including stocks, mutual funds, ETFs, and more. Any interest or dividends you earn on your investments, as well as any gains on investments that you sell, are subject to taxes in the year that the money is received. So any realized gains, any dividends. Now, note that you must be at least 18 years old to open a brokerage account, and there is no limit on how much you can contribute to a taxable brokerage account. So a lot of people I know invest in a retirement account, and once they reach that threshold, they'll go into an individual investing account. Now, if this time horizon is long-term, or for your retirement, you can choose a retirement account such as a traditional Roth or SEP IRA, or roll over an existing 401k. This can all be done in M1 Finance. This is a standard brokerage account with access to the same range of investments as an individual account. The biggest difference between a retirement account and a brokerage account is the taxes. A retirement account, they have either deferred taxes or they don't tax you once you withdraw the funds. To have a retirement account, you must have earned income or a spouse with qualified earned income to income to be eligible to contribute to an IRA. These also have limits to what you're contributing for a Roth IRA and for deducting contributions to a traditional IRA. The maximum has been $6,000 in 2022, $7,000 if age 50 or older, and in 2023, $6,500. So yes, they did increase it a little bit, which is very exciting. Now, there are taxes and penalties if you do decide to withdraw before 59 and a half. So if you think you'll need the money earlier, then a Roth IRA might not be the best portfolio for you. There are some tax loopholes if you want to get a penalty-free option. That's beyond the scope of this podcast. Just know that there are some penalty-free options. Next, are you investing with your spouse or partner, or is this just you? Or are you investing for your children? In which case you will want to have a joint investing if it's with your spouse. Now, this is a taxable brokerage account, an account shared by 2 or more people, but it can be used with a non-relative. And just note that there is personal information, but again, there's no contribution limit. Also, if you are looking for a children's account, you're trying to set one up for your little baby girl, and by the time she's 18, you're like, here you go, we paid for college, congratulations, then you would be required to open a custodial account. This is a taxable brokerage account for a minor. Ownership of this account will need to be transferred when the minor reaches the age of maturity. So the owner of the account must be at least 18 years old. The adult maintains account control and transfers assets to the child when he or she turns 18 or 21, depending on the state. Now, there are 2 types of custodial accounts. There's the UGMA, Uniform Gift to Minors Act, and the Uniform Transfers to Minors Act, UTMA. The difference is the type of assets you're allowed to contribute to the account. So UTMAs are able to hold real estate, typical investments, which are cash, stocks, bonds, mutual funds. And once the money is in the account, it cannot be transferred to another beneficiary. And just note that these types of accounts can be used for any purposes. It doesn't have to be college tuition, unlike education accounts. Just be aware that if the child applies for financial aid, the assets in the custodial account are considered the student's and can impact their eligibility and the amount of the aid package. And then last, are you employed or are you self-employed? When you open a retirement account, it needs to be either traditional Roth or SEP IRA or roll over an existing 401k. You need to have a minimum income or your spouse for a retirement fund. This is if you're employed. If you are self-employed, you will want to open what's called an SEP IRA. The 2 main types of individual retirement accounts, or IRAs, are traditional and Roth. A traditional account is a type of account in which your contributions are made on a pre-tax basis. This is a key difference. This means that you may be able to deduct your contributions from your taxes during the years in which they are made. Since you are not taxed at the time that you make contributions to a traditional IRA, your money has the potential to grow more over time. It is when you begin taking withdrawals in retirement that you will be taxed at your ordinary tax rate. So you won't be taxed until you withdraw in a traditional IRA. A Roth IRA is a type of account in which the contributions that you make are made on an after-tax basis. These contributions are not tax deductible. A key benefit of a Roth IRA is that you will not have to pay taxes on your distributions when you begin to take them in retirement, since the taxes were already paid. So basically, you're paying taxes on when you first enter, but when you withdraw, you will not be taxed. For Roth IRA contributions, your income limits dictate how much you can fund the account. If you believe that your income tax rate will be lower when you reach retirement than it is now, you should choose a traditional IRA, so that you can enjoy tax savings now and pay lower taxes on money in the future. And there are no income limits as long as you earn a traditional income. Now, if you think the tax rate after you retire will be higher, a Roth IRA may be a better choice for you since you will not be taxed on your distributions. This is also a better choice if you want to avoid taking withdrawals, since Roth IRA accounts do not have required minimum distributions, while traditional IRAs do. Because of the Roth IRA limits, you might not be able to make regular contributions if your income is too high. The contribution limits for a traditional IRA are $6,000 per year if you're under 50. If you're older than 50, the maximum you can contribute is $7,000. Now, if you withdraw early, you will have to pay a 10% penalty on top of your income taxes on the amount that you withdraw. There's also a required minimum distribution, which means a percentage of your total savings in the IRA that you are required to begin withdrawing after you reach age 70 and a half. A few benefits of a traditional IRA are the ability to complete an IRA conversion to a Roth, a deductible for state and federal income tax purposes, lowers your adjusted gross income, and no traditional IRA income limits. Now, with a Roth IRA, there are a few differences. There's no age limit on who can open or make contributions to a Roth IRA as long as you are working traditionally. You can make contributions even if you are 99 million years old. If your compensation was lower than the dollar amount of $6,000 per year, or if you're older than $57,000 per year, your contributions are limited to the dollar amount of your earnings. You are able to take out your contributions tax-free at any time. Distributions from a Roth IRA can be taken before you retire under certain circumstances. A qualified distribution from a Roth includes taken at least 5 years after the Roth IRA was opened, or at least 59 and a half. Withdrawals of up to $10,000 to purchase or rebuild a home will also be penalty-free. A distribution because of a disability, or distributions to your estate after you die. Some benefits of a Roth IRA include contributions can grow tax-free, the ability to create a backdoor Roth IRA. This is another tax loophole that is beyond the scope of this podcast. Tax diversification and flexibility. M1 Finance also has an SEP IRA, which stands for Simplified Employee Pension. This type of IRA is an employee-sponsored retirement plan. Employees are not required to contribute annually. If you make contributions to your SEP IRA, these count toward your combined traditional and Roth IRA contribution limit of $6,000 per year. Your employer's contributions are capped at 25% of your compensation, or $56,000, whichever is less. This IRA type is particularly popular for sole proprietors, business owners with no employees, and freelancers because it lets them funnel a lot of money toward retirement as their cash flow allows without forcing them to fund anyone else's. So once you have chosen your favorite type of account that fits your own personal lifestyle, it's time to start shopping for those beautiful ETFs, indices, or individual stocks. And while we're on the subject of taxes, just note that some stocks do provide dividends or passive income that you can get on a monthly or quarterly basis. Apple will pay you a little bit of money just for owning their stock because they have too much money. But what happens is this is usually titled as a dividend, and at the end of the year, you will have to pay taxes on any passive income or dividends, which is known as ordinary income. There are dividends that are known as qualified and some dividends that are tax deferred. So depending on the type of account that you chose, also be aware that if you're choosing a stock that has a dividend or passive income with it, you need to know the tax implications for that individual stock or ETF as well. Because if you're in an individual investing account and you're getting ordinary income on your dividends, you will be paying a lot of taxes. So now you're probably thinking like, whoa. Okay, Supergirl Investor, you're going a little too fast. Like there are a crazy amount of stocks out there, indices, ETFs. I don't even know what I'm looking for. You're just telling me to put something in a brokerage account and then just like hope for the best. Don't worry, I've got you. Investing should be super simple when you're first starting out. And basically, we are just going to dip your toe into that ocean. We're not going to go off the deep end and go straight into that water. And we are going to choose the best ETFs that you don't have to think about, that you don't have to worry about, that will pay you money while you sleep. This is for the long-term beginning investor who basically has no idea what they're doing. Now, this is not financial advice. Disclaimer in the description, but these are the best ETFs to choose as an investing beginner for the long term. We are not going to look at high growth, high risk. We are going to look at very stable, very diversified ETFs. Stay away from crypto if you're just learning about this. I have had so many conversations about, I don't know that much about investing, but I know about crypto. No. These are very, very risky plays, and you can lose all your money, as we've seen with FTX. And I'm not talking about once you've researched 1,000 pages in crypto and you really, really understand it. I'm not saying not to invest in it then, but this is for the beginning investor who wants to retire early, who wants to make money in very low risk, high quality companies that are backed by the US government or by a highly regulated country. So let's uncomplicate everything. Let's make this super easy. All we're going to do is invest in every single company in the S&P 500. What do I mean by that? It is the 500 largest US companies. This means Apple, this means Microsoft, this means Google. You're going to have a very small piece of pie into this ETF, just a mall of companies. So instead of one store, it's a big mall that owns 500 companies. And we are going to go with ticker symbol VOO. So over 80% of fund managers do not beat the market. Over 90% of day traders do not beat the market and actually lose money and quit. So we are going to come up with the safest way for you to become a millionaire. And this is the Vanguard S&P 500 ETF. If you go into M1 Finance and you select your pie, you just have to type in VOO. When we're looking at the best ETFs, we're looking at these three key metrics. We're looking for diversification. VOO has it. It has number of stocks at 503. That means it has 503 US companies that are very high quality. Its main holdings are Apple, Microsoft, Amazon, Tesla, Google, Berkshire Hathaway, which is Warren Buffett's, United Health Group, and ExxonMobil. Number 2, we are looking at the performance. So on a 10-year basis, VOO has provided a rate of return of 231%. And last, we want to look at that little hidden fee, like we talked about earlier with the brokerage accounts, the hidden fee that nobody talks about, which is the expense ratio. So to make it simple, the expense ratio is basically for all of the management fees, whatever it costs to make and run this ETF. So this expense ratio is 0.03%. Vanguard is famous for having very low expense ratios, which is a key factor when deciding on which ETF to buy. This should be allocated as a large percentage of your portfolio as a beginning investor. The next favorite ETF, and again, this is Vanguard. I love Vanguard. I love being a bogglehead. VTI, Vanguard Total Stock Market ETF. It has an expense ratio of, again, 0.03%, has one of the largest market caps. It's very well diversified. And yes, I note that the yield to date returns, or how much the stock price has gone down, is 15%. But the 8% is on a year-over-year basis of over 50 years. They've gotten 221% returns for 10 years. Now, this has several stocks because it is the whole stock market. It has 4,028 stocks. Its main holdings include Apple, Microsoft, Amazon, Tesla, Google, United Health Group, Berkshire Hathaway, and ExxonMobil. Its biggest sectors include 14.3% in consumer discretionary, 23.9% in technology, 11.8% in financials, 14.4% in healthcare, 13.2% in industrials. It seeks to track the investment performance of the total market index, which represents 100% of the investable US stock market and includes large cap, mid cap, small cap, and micro cap. Now, that just means how big the company is. So if it's a large cap, it means it's a very large company like Google or Amazon. It's focused on industry weightings and market cap, as well as financial measures such as PE and dividend yield. Now, the last ETF may surprise you because it is not a commonly chosen best ETF for the long term, but I have a few reasons why I wanted to put this in there because of all of the data that has correlated to its exceptional returns. Before we get into my favorite last ETF to buy as a long-term beginner investor, as a younger investor or an investor with a longer time horizon, should you choose dividend growth or should you choose growth. I have a lot of data that is backed up, and I think you might find the results a little bit surprising. Some recent data just came out that Warren Buffett is now up 15% in 2022, while Mark Zuckerberg, one of the leaders in software for Facebook, Instagram, WhatsApp, is down 75% in the stock. So what went wrong? What we've been hearing from all of these gurus, especially Cathie Woods during 2020, is growth. Growth all the way. Growth will fuel this new world order, as she likes to put it. But is that really true? Just because we are having a contractual year in the macro environment, what is going on? So again, if you have a longer time horizon, or if you're a young investor, should you really go with this growth route when many of these companies are down 70, 80%? And highly speculative? Or should you go with Warren Buffett's method of value and dividends? And I think it's incredibly important to know what type of investor you are, but also to distinguish between growth and just not so great stocks or highly risky stocks. Because a company can tout that it's a growth or hyper growth stock, but if the financials don't back it up or they have a really poor quality balance sheet, that is not something that any investor should really invest into unless you do have a high risk tolerance. What I like to think of growth is dividend growth or compounders that are high quality, long-term companies that have a great balance sheet, that don't have debt, and that are going to outperform the market. So I see growth companies as outperforming the market, and that just means buying high quality companies that have good financials that you think will go up more than 8%, that you can buy for dirt cheap on fire sale now. So I think the term growth, especially for young investors and for investors with a big time horizon, needs to be updated a little bit. Because personally for me, I do not want to buy hyper growth stocks that have a terrible balance sheet, that are diluting shareholders, that are not giving me profitability or any type of consistent return. I'm looking for the high quality companies that I believe are doing monster growth within the next 10 years. That's what I define as growth. So do we go with the dividends and value, or do we go with the growth if we have a longer time horizon? And longer, I mean 10 or more years. It's a bit startling, but from 1930 through 2017, dividends have accounted for about 42% of the total return. Yet people think of these like an old fuddy-duddy because they're not as much fun. They don't go up in stock price. They don't give you that, oh my goodness, this went up 10% in a day. It gives you that consistent cash flow, that consistent paycheck every month or every quarter. And that's what dividends are. If you want to outperform the market in the long run, and this is through historical data, lots of evidence-based, the way you get there is through these three key factors. Number one, it pays a dividend. As we just mentioned, it's 42%, almost half of the S&P 500. Number two, it has great fundamentals and it is growing. And number three, it's undervalued. So we're basically looking for dividend growth stocks that have great fundamentals, are growing, and are undervalued. From 1972 to 2017, all dividend payers returned 9.25%, which beat the S&P 500. And those that did not pay a dividend only returned 2.6% per year. So if you are looking to beat the market, we want to go with those dividend stocks, at least from a historical standpoint. So now that we know what dividends are and how they outperform the market, what are dividend growth stocks? A company that pays a dividend consistently, whether monthly or quarterly, but that is able to pay a consistent dividend and grows that dividend. And I would like to see a growth of 5 to 10% on a compound annual growth rate. So we're talking about companies like Starbucks, companies like Costco, companies like ExxonMobil. They all pay dividends and they are all growing that dividend consistently. These dividend growth stocks have great fundamentals, which means that their revenue is growing within the past 10 years. They are profitable. They have a lot of free cash flow that is also growing. They have zero leverage or zero debt, or their debt to EBITDA is less than 3, and they are growing their company. You can see that the story is growing. You can see that their sales are growing. You can see that their daily active users are growing. Peter Lynch, one of the most famous Value Investors says you can buy a great company, but if it is not undervalued, you are not going to get the returns that you want. If you go into Forever 21 or you go into Zara, you want to go into these stores when they're on sale and it's 50% off and you're like, oh my gosh, I have to buy this sweater. It's absolutely gorgeous. It's high quality. It's beautiful. It's made in the US. It's cruelty free. And I would pay $40 for the sweater, but it's on sale for $20. Of course I'm going to buy it. And then you can resell it later for its market price, which is $40. You make $20. That's exactly what stocks are. You buy when it's lower than you think the actual value is. So getting rid of these terms of a growth investor, value investor, dividend investor, the evidence is very clear. So we want something that pays a dividend. We want something with great fundamentals that's growing, and we want to buy it at a cheap price. So last but not least, the best ETF is ticker symbol SCHD. So if we go to M1 Finance, we're just going to type in SCHD and add that to our pie. This is the Schwab US Dividend Equity ETF. Has a very low expense ratio of 0.06%. The fund's goal is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index. It's low cost for tax efficiency, well diversified, and it's focused on quality and sustainability of dividends. So this is what I was talking about with dividends. So we have VOO, VTI, and SCHD. VOO is our largest US companies. VTI, we have the whole total stock market, and then SCHD is our dividend growth that is going to give us that juicy passive income on a quarterly basis. It has a total holdings of 103 companies. Top 10 holdings include Merck, Pfizer, Pepsi, Texas Instruments, IBM, Home Depot, Verizon, Amgen, Coca-Cola, and Cisco. Cumulative returns are 12% in 10 years, and it looks at quality dividends that are growing. So looking at these three ETFs is a great way to start investing. It's very diversified, very low cost, and it's one of the best portfolios that you can have as a beginning investor. It's basically where you can just put as much money as you possibly can into investing, not worry about it, know that you're getting the best companies on the planet. But let me know in the comments what your favorite ETF is, what your favorite stock is, and what stock I should analyze next. So you're still probably thinking, okay, Supergirl Investor, those are the best ETFs, but I still do not know what ETFs are. Please explain them to me like I'm 5. ETFs are exchange traded funds, and basically, like I said before, it's not a store, it's more like a mall. So instead of getting one company, which is the equivalent of one stock, you're getting a whole bunch of companies, which is the equivalent of one ETF, which in turn makes it very diversified and lower risk. My favorite thing about ETFs is that they trade like stocks or like companies. You can buy and sell them at any time. They're what's known as very liquid, meaning they're very cash-like. You can trade them as you please. Now with M1, you can only trade during the trading window, which is 9:30. If you need to get your money out right away, you can do that. So that's the difference between ETFs and stocks. But I'm sure you've probably heard of ETFs, index funds, and mutual funds. What's the difference between index funds and ETFs? ETFs can be bought and sold during the day, and index funds, like if you go into a Vanguard portfolio and you choose VT Sachs, that can only be traded at the set price point at the end of the trading day. So it's not very easy to take your money out. Plus, you don't really know at what price point you're getting that fund at. So with ETFs, you know exactly what price you're buying if you set a limit trade. Whereas with indexes, you get it for at whatever price is settled on that day. And you can only buy or sell once per day. Also, ETFs are generally lower cost, and historically both have performed very well. Now, stocks will always be riskier than if you get a bond or a CD or a high yield savings account, but usually the ETFs and index funds are both lower risk than individual stocks. Index fund investing is considered by financial experts as a rather passive investment strategy. It appeals to the value investor or someone who wants to keep their money in for the long term. Sometimes indices have minimum requirements, like VT Sachs. If you want to add money into it, you need to first put in $3,000 minimum. So if you're the type of investor who just wants to buy, they don't care what price it's at, they want to diversify in high quality companies, then indices might be the best for for you. If you're looking for ETFs and you do care about what price you want to enter at, setting a limit order and buying when you feel the price is on sale is a better decision for you. The main difference between indices, ETFs, and mutual funds is that mutual funds are managed by a money management professional. So you're getting a professional who is specialized in buying certain funds for you. Now, because it is managed by a management professional, they have a lot of costs associated with them, and historically, more than 80% of mutual funds do not beat the market. So the retail investor actually has a very unique position. Retail investors, just by buying the S&P 500 or just buying the best ETFs that I laid out for you, actually have the potential to beat the market, beat mutual funds, and beat day traders. Also, mutual funds are like indices where they are only priced at the end of the day. So again, you do not know what price you are buying in or selling at. So now that you know a basic framework of what ETFs versus indices versus mutual funds are, I would like to hear your thoughts on what ETFs, indices, or mutual funds are your favorites, what questions you have about them. Again, I want this to be a very back and forth. So as promised, we are going to talk about the 5 top stocks to buy and hold for the long term. If you want me to give a deep dive into any of these stocks, please let me know in the comments below. The first stock that we are going to talk about to buy and hold forever is ticker symbol MSFT. This is Microsoft. It's in the tech sector, and it is one of the largest market caps in the world. Now, not only that, but they have a lot of free cash flow. They've been growing revenue the past 10 years. This is a beast with a fundamentally conservative balance sheet. Now, this is known as a dividend grower because they have been growing their dividend the past 10 years. It has a market cap of $1.88 trillion, and the PE ratio is a bit high with 26. It has a dividend yield of 1.1%. Now, don't let the PE ratio fool you. That does say that it is a little bit overvalued, but compared to the free cash flow, you're actually getting it at a cheap discount. I personally believe that Microsoft is going to go up in the next 10 years at an IRR or return of around 10%. So you will be getting 10% of your money plus getting dividends. It's a very high quality stock, and compared to Google that has been burning money like crazy, Microsoft is actually conservative and is actually working to create a great balance sheet. Next, we're going to look in the consumer staples sector, and this is going to be ticker symbol J&J. You've probably heard of it with all of the ducks. Johnson & Johnson. Some of the company's most iconic brand names is spinning off into its consumer health division. It will be named Kenvue for Tylenol, Band-Aid, and Johnson's baby powder. While that is taking 16% of the company's total revenue, it has a very strong balance sheet, and I don't think that's anything to worry about. It's very safe, very high quality, and I predict that it will grow within the next 10 years with an IRR of 12%. It has stable revenue, very consistent and predictable earnings, and the brand has pricing power, which means that they are able to get higher prices and consumers will still purchase. The company has a solid dividend with over a 2% yield to help boost investors' total returns. The market cap is $462 billion US, and right now it's at $177. And while I don't think generally the healthcare sector is undervalued at the moment, the price at which Johnson & Johnson is at right now is a little bit on the high side, but if you can get it at a dip below 160, I believe it will be a great return on investment. Number 3, we have ticker symbol BX, which is Blackstone. Now, this is a $1 trillion asset under management company, making it one of the world's largest asset managers. What you may not realize is it also owns a lot of real estate in the US. Not only has it been increasing revenues and been an outstanding global asset manager, it also has $182 billion in dry powder or cold hard cash. At its current rate, I believe it could be a $2 trillion company in 2026 with a juicy dividend yield of 5.5%. The CEO points out that its number one commitment is to avoid losing our clients' money, and we've done an excellent job of that. So many investors are concerned right now because there was a startling sell rating from Credit Suisse, noting the retail outflows. And while this is normal in a contraction of the macroeconomic factors, I do believe that it is temporary. So they are basically hoarding all of this cash so they can get more opportunities. So I think this problem is very temporary. I believe that they are experts at what they do, and they have a lot of dry powder to be able to make plenty of opportunities. It has a market cap of $107 billion and it's currently trading at $88. And it's actually the largest alternative investment firm globally. And it's been through several recessions. I think it can bounce back. It's one of those beautiful recession-proof companies. Now, this company is a bit more of a curious case because while I personally think it's undervalued and think will return a very juicy dividend, I do think because of the sell ratings and because of the downgrades, there will be a lot of selling pressure, and I do think it will go around the $60, $70 range. So if you want to start a small position in it, the fourth company that I'm looking at to buy and hold forever is Realty Income, ticker symbol O. We need a real estate stock because those tend to drive the best dividends. It has a dividend yield of 4.61%, a market cap of $40 billion, and it's a real estate investment trust, or REIT, which is one of the safest type of real estate stocks. It's incredibly well diversified with many residential properties. This is known as the monthly dividend stock, and it pays monthly from rent collections. It has a 53-year track record of providing dependable monthly dividends that increase over time. Not only that, but it's profitable and it has been increasing revenue for the past 10 years. It has a 4.4% compound annual dividend growth rate and a 14.4% compound annual total return. Focuses on high-quality risk-adjusted returns of property. In this high rate environment, we need to choose companies that are very high quality in what they are choosing as far as their real estate investing portfolio goes, and this is no exception. It has a very great track record. Of course, it is a little bit on the higher side. I would wait for a dip below $60. Number 5, and one of my favorite dividend stocks to buy and hold for the long term, is ticker symbol ABBV. Now, this is AbbVie, spun out of its parent company of ABT, or Abbott Labs, in 2013. It is a biopharmaceutical product company with a lower margin business of medical devices and consumer health products. Since its spin out, it has more than tripled to outperform the ABT business. So talk about huge growth. And I believe this is very sustainable. It's working hard to come up with a full pipeline of profitable treatments, has a glucose monitor for type 2 diabetes, which should hit $4 billion in sales this year, has a very strong outlook, and analysts are expecting it to outperform the market. Its dividend yield is currently 3.8% with a market cap of $281 billion. Again, I do believe it is overvalued a bit, so I would wait until it's at 150 or lower to buy the dip, but you can have a starter position. This year, it hiked its payouts by 5%, and its dividend is now more than double what the company was paying 5 years ago, so it's high dividend growth. It's known as a dividend king, which means that it's been increasing its dividend annually for more than 50 years straight. Looking at the payout ratio, we can see that this is sustainable, and it should increase or maintain its dividend within years to come to adjust for inflation. So now that you know my top 5 buy and hold forever stocks, what are your buy and hold forever stocks? Let me know in the comments below. And as always, this is Supergirl Investor here to save the world and make you wealthy. I hope you enjoyed the first episode of this podcast. If you did, let me know. If you would like to talk about a different topic as far as investing or finance goes, please let me know, because I'm trying to save the world, make you wealthy. We're looking for affordable, healthy products and healthy investing instruments. So let's all get wealthy together. Be sure to click the link in the description below for a bar chart for the free stock screener and to get my free Excel dividend track sheet. Bye, future millionaires.